gross domestic product or GDP is a widely used measure in national income accounting. It is used by many for various purposes. The policymakers in a country like finance minister and central bank heads use the measure of GDP to understand the level of economic activities to set the policy note. On the other hand, fund managers and industry captains use it to guide their investment decision. So GDP being such an important measure, it's worthwhile to understand how it is calculated. So GDP is the total value of goods and services produced in an economy. So GDP by definition is the total value of goods and services produced in an economy. GDP is the broadest quantitative measure of a nation's economic activity. So basically GDP measures the level of productivity in an economy. So that being the case, it is important to understand how an economic system works. The most important activities which happens in an economic system are your production and consumption. And production is an activity in which the producers combine the basic factors of production like your land, then labor, and then capital, and produces output. And for using this particular basic factors of production, they pay a factor payment to the providers of these factors of production. So the factor payment paid for land is rent, and the factor payment paid for labor is wages. Factor payment paid for capital is your interest and dividend. So the providers of this factors of production are basically individuals, and this factor payment paid by the producers becomes the income for these individuals, and these individuals in turn use this particular income for consume the goods and services produced by producers or the firm in the production activity. So that becomes the expenditure. So in a consumption activity, your individuals exchange income or a price for consuming the goods and services produced by the producers. So when it happens, you have a economic transaction happen. So by looking at this simplistic model of an economic activity, wherein individuals provide the basic factors of production and your producers pays the factor payment in the form of interest, dividend, wages, and rent for providing factors of production, and this becomes the income or the national income in the economic system. Okay, so in order to understand the level of productivity or the total production activities happening in economy, you can measure the national income paid by the producers to the individuals. Or on the other side, you have the individuals or the consumers use this particular income and consume goods and services. Okay, so that becomes the expenditure side. So you can measure your expenditure side also to understand the level of economic activity happening in an economic system. And there is one more method for measuring GDP, which is by measuring the total production activities which happens in the economic system. So basically you can measure GDP using either of any of these methods, either by income method wherein you measure the national income, or the consumption approach wherein measure the expenditure side in the economic system, or the production wherein you measure the total value of goods and services produced by the firm. And this is also known as a value added approach. So this simplistic model of GDP or the economic system become a little complex when injection of income and leakages of income happens from the economic system. And the major reasons for injection of income in the economic system are when the private and business enterprises invest in the economy, income is introduced into the economic system, and when the government spends, that also results in injection of income. And when you export, you receive money from abroad for a production activity happened within the country. So that also results in injection of income in the economic system. And the major reasons for leakages of income from the system are your savings by individual and tax by the government, and then import. So when you import, the country's resources are used on a product or or an item which is a result of a production activity which is happened outside the economic system. So income gets leaked out of the system. So when you calculate GDP, you have to consider these aspects of injection and leakages of income happening in the economic system. Okay, now let's look at the expenditure method for measuring GDP. So in expenditure approach, it measures GDP based on the total spending on all final goods and services. And for calculating gross domestic product, the expenditure method measures the total consumption, investment, government spending, and the net export. So you have a formula for that one, wherein GDP is equal to your consumption plus investments plus government spending and the net export. Okay, so C stands for the value of goods and services consumed, and I is the gross investment, G is the government purchases, and X minus M represents the net export. Now let's look at each of these items in detail. So consumption. Consumption is the largest category in a GDP, and it accounts for 2/3 of the total GDP. And consumption in an economy is affected by some factors, some other elements. So for example, interest rate. When the interest rate in an economy goes up, people tend to save more rather than spending the money. So when the interest rate goes up, consumption in the economy goes down. And then taxes. When taxes goes up, that leaves the individuals with lesser amount to spend, which means that the disposable income in the hands of individual goes down when the taxes goes up, which results in lower consumption. And then you have income. When the income goes up, needless to say, the consumption also goes up in the economy. And then investments. Investment is basically measured based on the total investments in fixed investment, inventory investments, and residential investment. Your fixed investment comprises of investment on capital goods and plant and machinery. And your inventory investment is the change in goods awaiting sales in the shop shelves, and the goods which is there in the godown, which is need to be converted into final goods and services. So inventory investment represents that. And you have residential investment. Residential investment is the amount spent by individuals on residential properties. So these are three components of the item investment for the purpose of calculating GDP. And then net export. Net export is nothing but the difference between a country's export and an import. Export is a foreign country's spending on domestic goods, and on the other hand, import is domestic spending on foreign goods. So in export, you are receiving income, and when you import, income is going out of the system. So when your net export is positive, then you have a trade surplus, and on the other hand, when it is negative, then you have a trade deficit. And if both export and import are matching, then you have a trade balance. So measuring GDP based on expenditure method, you add up your consumption, total consumption happening in the economy, plus the investments done by the business and individuals, and then the government spending, then the net export. Now let's look at the income approach for measuring gross domestic product or GDP. And GDP based on income approach works on the formula, that is your NY plus IBT plus CCA and D plus NFP. Your NY is the national income, IBT is the indirect business taxes, and D is the CCA and D is the capital compensation allowance and depreciation, and NFP is the net factor payment. Now let's look at each of these items in detail. So national income comprises of wages received by individuals, and a profit paid to the entrepreneurs, and the rent paid to the landowners, and interest paid to the providers of debt capital. And when it comes to indirect business taxes, you have sales tax, value added tax, and your service tax. Capital compensation allowance and depreciation. Capital compensation allowance is the investment needed to maintain the level of human capital. So for example, it's the expense required to train and educate the new set of workers to replace the retirees. So that's the capital compensation allowance. And now the depreciation. Depreciation is the reduction in the value of an asset over a period of time due to wear and tear. And now net factor payment. NFP is the payment of factor income to the rest of the world minus receipt of factor income from the rest of the world. And we have seen that a factor payment is basically the compensation given for the providers of basic factors of production like your land, labor, and capital. So any factor payment like rent, wages, and interest paid on foreign asset but deployed in the country, like a salary paid to an expat worker or a dividend paid on a foreign capital investments, are the factor income paid to the rest of the world. Though paid to a foreign asset, they are essentially pertaining to a production activity happened in the domestic economy. So while calculating GDP, you have to add those capital compensation, that factor payments to the while calculating GDP. And similarly, any wage received by an Indian citizen but working abroad or a dividend received by a domestic investment abroad are factor payments pertaining to a production activity happened outside the country. So such factor payments need to be reduced to calculate the productivity of the domestic economy. So measuring GDP based on the income approach, the formula that we use is your GDP is equal to you add your national income plus indirect business taxes plus capital compensation allowance and depreciation and the net factor payment. Now let's consider the value added approach for measuring GDP. Value added approach is essentially a method which uses which considers the production activities in an economic system. It works on the formula that is value added is equal to value of production minus the intermediate goods. Intermediate goods are those goods which goes into the production of the final goods. Okay, let's try to understand this particular methodology based on an example. Okay, so let's consider the economic activity which is a making of a biscuit. Okay, so it all starts with a farmer who harvests a wheat, and his cost of production is rupees 100. So value added by the farmer for harvesting the wheat is 100 rupees, and a miller buys this wheat and he in turn makes flour out of that, and the value added by him is 100 rupees. Now the cost of product has become 200. Now a baker buys this flour and he bakes biscuits with it, and the value added by him is 100 rupee, and now the cost of product has become 300. So the total value of production activity happened in the economic system is 600 rupees, and the total value added, which is the value of the intermediate goods, is 300. So under your value added approach for calculating gross domestic product, it is your value of production minus the value of intermediate goods, which is 300. So you can see that the value of intermediate goods, the value added, and the value of the final goods are the same here. So while calculating GDP based on value added approach, in order to avoid double counting, you either take the value of the final goods or the value of the total value added. So now let's consider two simple economies which produces only biscuits and milk. So we have a country A and country B whose GDP consists only of biscuits and milk. So in the year 2015, country A produced 1000 packets of biscuits at a cost of 100 rupee. So the total value of biscuits produced by country A is 1 lakh. Similarly, country B produced 1000 packets of biscuits at a cost of 100 rupee, and their value of producing biscuits are also 1000 rupees. and country A produces 1000 liters of milk at a cost of 50. So 50,000 is the value of milk, and so is the case with country B. They produces 1000 liters at a cost of 50. So the total GDP of country A and country B in the year 2015 is 1,50,000 rupees. All right, and now let's go to year 2016. In the year 2016, the biscuits produced by country A are 1100 packets at a cost of 110 rupees. So the total value of production is 1,21,000. And the milk produced by country A is 1100 liters and at a cost of rupees 55, and so the total value of production is 60,500. So now the GDP of country A in the year of 2016 is 1,81,500. And when it comes to country B produced the same quantity of 1000 packets of biscuits, but the cost of production, the price of biscuits packets have gone up to 121. So here the total value produced is 1,21,000 as far as the biscuit is concerned by country B. And their production of milk is also stagnated at 1000 liters, but cost of production, the price of milk has gone up to 60.5. So the total value of milk produced by country B in the year of 2016 is 60,500, and that makes their GDP also equal to 1,81,500. So if you consider these two economies, you can see that their GDP are the same, and this GDP is a growth of 21% over the previous year's GDP. So does it mean that both country A and country B performed equally good? It is not so. The productivity of country A has gone up, but whereas in the case of country B, the productivity is still stagnated at the same quantities, but the GDP shows a growth rate, and this is primarily because of the rise in prices, or in other words, it is because of the inflation that country B's GDP has gone up. And this is not a true reflection of the productivity of both the countries. So a GDP which you calculate in this way is known as a nominal GDP. And we have seen that when you represents your GDP as based on nominal GDP, it is not a true reflection of the productivity of the economies. Okay, so we need to understand the real GDP of these two countries to understand the real productivity of these economies. So since in nominal GDP, the GDP figure is blemished with the effect of inflation, it's important to understand the real GDP of a country to reflect the productivity of the economy. So an inflation adjusted GDP is called the real GDP. To understand the concept of real GDP, let's get the figures of those countries back on the screen again. Okay, so to adjust for the price change, real GDP is calculated using prices from a specific year or on a base year. So using this concept, let's calculate the GDP of country A in the year 2016. So the total value of biscuits produced, the total quantity of biscuits produced by country A in the year 2016 is 1100 packets. Okay, and for calculating real GDP, we will take the price on 2015, which is the base year. So 1100 multiplied by 100, you have 1100. So that's the total value of biscuits produced in the year 2016 by country A. And the total value of milk, the total quantity of milk produced is 1100 liters at a cost of 55 in year 2016, but we are going to use the base year price, which is rupees 50. So that is 55,000. So the total GDP of country A in the year 2016 is 1,65,000. And considering this is a growth of 10% over your 2015 figure. So if you calculate GDP in this way, you will get a more clarity with respect to the real productivity improvement happened in the economy, which is 10%. So similarly, if you calculate GDP of country B using the same methodology, you can see that the growth rate in GDP is 0%, which is a true reflection of the economic activity of that country. Because we can see that the quantity produced, both milk and biscuit, is stagnated as far as the country B is concerned when you compare 2015 and 2016. So effectively, when you calculate GDP based on real GDP approach, you calculate based on your current year quantity with a base year price. So economists, to understand the effect of this inflation better, they used a methodology called a GDP deflator. GDP deflator is a measure used for deflating the effect of inflation from nominal GDP. So GDP deflator effectively represents the productivity of the country. So GDP deflator is the measures the ratio of nominal GDP to the real GDP. So GDP deflator is equal to your nominal GDP divided by real GDP into 100. So let's calculate the GDP deflator for country A. Nominal GDP is 1,81,500 divided by 1,65,000, which is the real GDP, the whole multiplied by 100. So the GDP deflator for country A is 110. So GDP deflator, as I said, is a true reflection of the productivity of the country. If the GDP deflator is more than 100, which indicates a improved productivity. If it is less than 100, say for example 50, which means that the productivity of the country becomes half. So productivity in the base year, let's say 100 packets, and productivity in the current year, it's 1000 packets. So GDP deflator 1000. So the measures of GDP, and depends upon your purpose of calculating GDP, you have to use the appropriate measure, and it is important that you normalize the GDP figures using your real GDP concept and GDP deflator to understand the clear picture, the clear productivity in the economy. So that's all for the time being. Thanks for listening and watching the video. And as always, please subscribe to the channel and like our video. That would be a huge motivation for us. Thanks once again.